Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Saturn Oil and Gas Inc. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Kevin Smith, VP of Corporate Development of Saturn Oil and Gas Inc., which trades on the OTCQX Best Market under the symbol OILSF and on the TSX under the symbol SOIL. Welcome back, Kevin.
Thanks, Matt, and thank you all for joining. We are a Calgary-based Canadian oil and gas producer. We're a conventional producer in the prairie provinces of Alberta and Saskatchewan. So a typical installation is in a farmer's field where we lease a small patch of land and go about harvesting the oil resources deep underneath the ground. Of course, the fields look a little bit more white these days, but typically, a big part of what we do is try to reduce our footprint in everywhere we operate. Also, a little moniker on our homepage here that we were the 18th fastest growing company in Canada. Last year is ranked by the Globe and Mail magazine's report on business. That puts us the fastest growing oil and gas company in Canada. So I'll kind of step you through how we got there and some of the growth we've had over the past few years. We also, home listed on the Toronto Stock Exchange on the main board here. We graduated from the Toronto Stock Exchange Venture last year. And of course, delighted to be on the OTCQX. We've seen our volume go up quite dramatically year over year. I see here in March that we're up about 2.5 times the volume that we traded last year. So we're seeing quite a bit of liquidity, and we have quite a few U.S. shareholders, and I'll touch on that in a bit too. We'll be talking about some forward information, so I will let you guys read that at your leisure as we talk about some of our guidance here. Looking backwards right now, when I joined the company early in 2021, the company was coming out of COVID, and really it was a fresh start for the company. We were about 200 barrels a day of light oil through a series of pretty impactful drilling programs and some strategic acquisitions. We're currently producing about 27,000 BOE a day. We're very focused still on light oil. A little over 80% of our production mix is light oil and natural gas liquids, the high margin hydrocarbons. And so we're generating quite a bit of cash flow. We just put up a couple of consecutive $100 million EBITDA quarters. We reported our Q4 last week on Tuesday, a week ago. So looking forward, we're guiding for about $365 million of EBITDA on a per share basis. We're looking for close to about $2 per share. I think the midpoint of our guidance is $1.93 of cash flow per share. Based on where we're trading today, I think we're about 1.2 or 1.3 times cash flow. So I think a good indication of the strong value that we're trading at right now. We've kind of switched modes right now from growth to harvest mode. Now that we've put this package of assets together that's developing quite a bit of free cash flow, we're looking to sustain this cash flow now going forward. We have a deep inventory of projects that are on the land that are already in their inventory. So we think we can sustain this production for the next 2 decades. So what we're looking at now is rather than the growth side of business, we're really looking at optimizing our balance sheet. And that means paying down debt as rapidly as possible. We have a lender out of New York. It's a family office. They've been a terrific supporter of ourselves. They've backstopped us for the last 4 acquisitions that we've made. The last being a private company that was quite a large acquisition for us at the beginning of last year. And since then, since even the beginning of last year, we've now paid down about $215 million of debt, and we're rapidly paying that down every month. Our monthly principal payments are about 25 million Canadian every month. So we're looking to pay down this year about $180 million. So currently, net debt at the end of last year, we did an equity offering last month to top up the treasury. So we're about $413 million Canadian in net debt, with our trading share price somewhere around $2.30, $2.40 Canadian. This is about a $370 million market cap. And the idea here is for value creation for our shareholders. Maintain the enterprise value, maintain production. About 50% of our cash flow goes towards the drill bit. Since we have such high efficiency rates of return on our invested capital, we need about 50% of our cash flow to maintain the production levels. The other half of the cash flow then goes paying down debt to the point where we're targeting somewhere about $280 million of net debt by the end of this year. And if you follow that to its logical conclusion, the company would be debt-free by the beginning of 2026. Sometime between there, we'll probably take the debt and probably term it out and make it a permanent part of our capitalization. But so really what we're looking now is just harvesting the cash flows we have on hand. Since we're looking at the capital structure, 161 million shares outstanding, we have some rather large U.S. institutional shareholders. One of the companies that came in to backstop us last year was GMT Capital. They made an initial investment in us at the start of last year and have been adding to that position. I think currently they have about 45 million shares. That's about 28% of our shares outstanding. GMT Capital, it's a private wealth fund for a family out of Atlanta, Georgia. Also, a company that's been with us for a while as an investor is Libra Advisors out of New York. They currently hold about 17 million shares. It's about 11% of our shares outstanding. Another family office, this time based in New York. Great supporters. They've been with us since 2021. So between the two of those U.S. shareholders, they hold about 40%. I would say if you added up to other institutions, about 2/3 of our shares are held by institutions. And so we do have a relatively smaller float, but we have large shareholders, and I think that leads to some pretty large expectations. So looking at our platform right now, like I said, we're in the prairie provinces of Alberta and Saskatchewan. We have 4 main asset areas. I'll start with the bottom left from southeast Saskatchewan, about 12,500 BOE a day. About 95% of that production is light oil. Certainly this is our large cash cow that we've had. We grew the production in this area here by 65% last year. So it's certainly where a lot of our capital goes to work. On the other side of the province, on west central Saskatchewan, we have a Viking play where we currently have about 3,500 BOE a day. Again, 95% light oil out of that area. We added last year 2 core areas in Alberta. In central Alberta, we have a large, well-defined Cardium play. In itself, it's 8,000 BOE a day. Be a company by itself, but we did some great drilling there last year, and the Cardium light oil is our target in that area. And then in northern Alberta, just under 3,000 BOE a day, we are in a Montney play and the Swan Hills play as well there. So in total, we put out our reserve report last year. I'll touch on that in a bit. In January, from last year's reserves, 145 million BOE of 2P reserves, giving us a long reserve life index. And within there, we have over 800 net booked locations. Our reserve auditor, Ryder Scott, has looked at all these locations and see that they're quite economic and part of our future sustainable production growth. We have over 500 other locations that we have off the books that we've identified within the lands that we hold. So our current drilling pace of just over 60 wells per year, we have over 20 years of drilling inventory. Everything we do is focused on light oil, and that maintains us some of the highest margins in the oil patch. And like I said, on Tuesday last week, we put out our second consecutive quarter of just over $100 million of EBITDA. It's up quite nicely over the past few quarters as we were previously in growth mode. Speaking to our reserves, fantastic report, high watermark for ourselves in terms of on the bottom left chart. We ended 2020 with about 6.5 million BOE of 2P reserves. That's increased annually, where we've gotten to now about 145 million BOE of reserves within our current land package. We think there's quite a bit more than that, but that's where our third-party auditor came up with. And I would say within that, on the 2P basis, the 145 million BOEs is on a PV 10% discounted basis, about $2.8 billion Canadian in value. The metric we usually look at is the proved developed producing reserve value, the PDP. We have an estimated net present value of 10% of about $1.4 billion. If you put that on a per share basis, including the proceeds of the equity offering from last month, we're about $6.10 of a net asset value. So we're trading at about 40% of our net asset value. I think if you look at our peers, you would see that's probably the largest discount in the Canadian oil patch currently. And then last chart on the right-hand side, just walking you through the last 3 years that we've done. Good to look back and say at what cost are we adding those barrels. In 2021, our finding, development, and acquisition cost was about $6, and we enjoyed about a $36 net back in the field. So we had about a 6.2 times our cycle ratio. That was quite a special time when you could acquire assets very inexpensively coming out of COVID. Walking forward, we did about a 2 times our cycle ratio in 2022 with getting a much higher netback of over $65. Last year, we did a 3 times our cycle ratio. But all in all, on a 3-year average, we've added over 150 million BOE on an FD&A basis at an average cost of $14.35. That includes future capital for the development of future drilling locations. So we'd stack that up against anyone in the industry, and you'll see that that's top of the pack in terms of recycle ratio, and it shows indicative of the good economics there are here in the Canadian oil patch. One of the things we also look at is our cost structure. Year over year, we've continued to decrease our operating costs on a per unit basis. We started in 2021 with about $28 op costs. We've got that down to about $21.60 Canadian in the past year. Our royalties have also come down from over 15%. We're just under 12% now, and so that's down 25%. What's certainly important to get a high price for your oil when you go to market to sell it. It's why we focus on light oil. It's also more important how much of that you keep within your netback. On the right-hand side, you see in 2021, our operating netback after derivatives and our hedging impact, we were about $25.70 of a netback. That popped up nicely in 2022. Oil averaged over $95 US on WTI. We enjoyed $43.80 netback, with oil falling back to averaging closer to $75 in 2023. We still enjoyed a $43 netback, and that's a credit to our decreased operating costs, the reduced royalties, and certainly there was an effect of a strong US dollar too. I think that one of the best things for all Canadian producers where we export our commodities has been the strong US dollar. The last bar I'll look at is important for people to realize on our new drilling and why we have such a robust drilling program, and a lot of it focused in Saskatchewan. Initial wells on a horizontal basis tend to come with a royalty holiday, reduced royalties for initial production, as well as they tend to come on at a higher volume, which reduces the per unit operating costs. So with oil at about $75 US, we expect to get about an $85 Canadian netback on our oil and gas produced for new wells. So that's why we have a pretty quick payback, high rate of return. Most of the wells we drill in Saskatchewan are close to about 100% rate of return, and they're paying back in less than a year. Digging in a little bit to southeast Saskatchewan, this is the border against, onto the east is the province of Manitoba, and we border against North Dakota to the south. And so we've tied up quite a bit of the productive land in here. We've got about 12,500 BOE a day, most of that 96% light oil and liquids. And we control most of the infrastructure in this area as well. Pretty important. It's a water drive reservoir here in the Williston Basin, so we do produce a lot of water, and you have to be able to handle that. We've got a 4,000 kilometer network of pipelines that take us to over 70 facilities, separate the oil and the water, take the oil and natural gas to market, and then re-inject the oil back down into the reservoirs. So we make a pretty good business actually out of renting out part of our facilities to other smaller operators in the area. But what's important is we control this infrastructure. So when we bring a new well on, we're typically very close to a tie-in point. So we have low cycle times to get investment turned into production and getting our payback periods quite tight. We've drilled about 25 wells in 2022, and last year we did another 25 wells in this area. We're looking to ramp that up to probably closer to 35 to 40 wells this year. We have a handful of wells already done this year, and we're starting off with quite a bang here for 2024. Look forward to putting those results out. You can turn your attention to our news release last week, where we give the IP30 results of every well that we drill. So we try to be quite transparent about that. For our development plan also, we launched a new website just a couple weeks ago. We've put out a guidance presentation. I encourage you all to take a look at that. I've had some pretty good feedback from our shareholders. It's quite transparent as well. It looks at where we're spending all of our dollars. We have a $145 million development plan for 2024. And what kind of rates of returns we expect, and what kind of well results we've had in the past in these areas. So a pretty detailed view of how we're going to sustain production by reinvesting half of our cash flow this year. One of the exciting plays that came to pass just last year here in southeast Saskatchewan is this Bakken resource play. It's a very large regional deposition, pretty homogeneous reservoir, so it takes away a bit of the risk of hitting the target. You tend to be able to develop sections of land all together at the same time. And so we've drilled a number of wells in this Bakken area last year. One of the new trends that was coming off a new drilling technique that has caught a little bit of fire in Alberta, here in Saskatchewan, just last year, we saw our competitors start to do this open hole multilateral drilling, where really what you're doing is taking one vertical well bore and underground, splitting that off into up to 8 horizontal laterals. What this allows you to do is have a little less disturbance at surface, smaller footprint for your development, but also these are drilled open hole and they're not stimulated, so there's no hydraulic stimulation in here. Really reduces your completion costs and allows the wells basically to drain given their own permeability of the rock. And so we developed 2 of these last year, and the industry probably did about 25. And last year was pretty much the first time we've seen this development technique in this part of Saskatchewan. Our 2 wells came on at an average about 168 barrels a day. That's a big win for us. We typically look for closer to 150 barrels a day of light oil coming off these type of drilling. So we're already now back at it. We're currently drilling another one. We have about 2.5 of these we expect probably here in the first half of the year, and look to see where we can take that from. The success that we had with the drilling of 2 last year, Ryder Scott's given us 17 booked locations, and we probably have another 90 that we've identified on our land. We're one of the biggest landholders in here. Another landholder is Crescent Point, our larger intermediate producer here in Canada, and then there's another private company in this play as well. So we expect this to be a big part of our drilling program going forward. Also important to point out, why we took this on in the first place is it's tackling areas of land that we found that do have a large supply of oil in the reservoirs, but are pretty tricky to take out on an economic basis. So a year ago, all of this land that we're now developing was deemed to have zero economic value. And applying this new drilling technique that's come from innovative drillers and producers of oil here in Canada, we've taken something with very little value and turned it into quite a lot of value. So that's another big win for ourselves year over year. Also on the conventional side, that where we drilled, we did quite a nice 6-well program last year in the Spearfish horizon. This is also conventionally horizontally drilled. The well results were close to 90 barrels a day and had very low declines, well above, probably 16% above our dotted red line type curve. So we're back at it this year, and Spearfish has been a great play for us. Spearfish last year development plan was the first time Saturn had gone over this horizon, and so it's now become a big part of our development plans going forward. Finally, on the other side of the province of Saskatchewan and west central Saskatchewan, this is that Viking resource play. The company was founded on this in 2017 and had basically, this is kind of our backyard where we started our growth. We have 165 locations here, probably another 200 on the books, our own books that haven't been booked yet, sorry. And that's about 20 years of inventory here. We have seen our initial well results go up incrementally year over year. We were close to about 98 barrels a day for IP30 for the 12 wells that we drilled last year. And that's up nicely from the wells in 2022. We'll probably do about 17 more Viking wells in this area. Very fast payback, light oil, and very economic for us. Moving into Alberta, a little bit deeper in the basin. These wells cost a little bit more to drill. They tend to come on at higher rates of production. We drilled 6 wells that we released in 2023. They came on in a combined production of about 1,300 BOE a day. So you get pretty chunky production out of these wells. Success of last year, we're following up with another 8 wells in 2024. And finally, northern Alberta, we drilled a 4-well pad in the Kaybob area. As the pad came on, close to about 1,250 BOE a day. So these are, again, great projects to add large blocks of production. We'll drill another 4-well pad in the Montney here in 2024. And so that's basically our program for 2024, amounting to about 62 net wells. We expect that to keep our production level flat, plus or minus 27,000 BOE a day for the calendar year. We run our economics at about $75 US WTI equivalent. And so that should bring, at a field level, just north of $400 million EBITDA. We do have some hedges in place to kind of take a little volatility out of the cash flow situation. And like I said, we'll be a midpoint about $365 million of EBITDA. For every dollar above $75 that WTI actually ends up for the calendar year, we'll probably see incremental EBITDA of about $3 million. On adjusted funds flow basis, we'll look for between $300 and $316 million at $75 oil. That's close to $1.90 to $2 of cash flow per share, what we're forecasting. After our development capex and some decommissioning expenditures to put old wells to rest, we'll have probably about $145 to $160 million of free cash flow. Currently using that to pay down debt very rapidly, but at some point in time, the debt will be repaid to a level that we think we to make it a permanent part of our capital structure, and then we'll have $1 of free cash flow that we'll have. Our board will have to decide on where to direct that towards. The obvious candidates are perhaps increased capital and get back into growth mode on an organic basis with the drilling locations we have in hand. Alternatively, share buybacks, certainly a good alternative given how low our share prices are trading compared to the value backing those shares, and then perhaps a dividend. But that's down the road and something that we'll probably be considering hopefully shortly, but we'll give that a little bit more debt repayment until we get there. We do have research coverage from 5 independent research analysts. I borrowed some of this comp information from Canaccord Genuity, Canada's probably leading independent advisor here in Canada. They have within our comp universe the average enterprise value to debt adjusted cash flow for 2024. The average group is about 3.5 times. We're trading about 1.6, 1.7 times. So I think we're probably at the bottom end of that metric. EV/DACF is pretty close to an EV/EBITDA multiple, and a good indication that there's a lot of value based on the cash flow our company is producing. Canaccord Genuity has about 117% upside on their target price, calling for $5. Our target price ranges from $4.50 to $5.80. So most of the analysts are looking for a double out of us, and I think we're top pick for Canaccord with the highest expected return. But if any of this is of interest to you, you can reach me at info@saturnoil.com. I'd be happy to pass on some of this research, as well as answer any of your questions if those do come up. And welcome. I answer that email myself personally. So that's info@saturnoil. So that's the formal part of my presentation. So thank you for that. But I do see a number of questions lining up here. So let me jump in here and start to address a few of these. I did mention hedging, and I do have a question here about please elaborate on your hedging strategy and our current hedge book. I'll jump ahead. I have a slide here for us in the appendix. So in the back of our presentation, you can find on our website, we have about 4 years of hedging outstanding, and we've dealt with our lender to get to this figure. Like I said, our lender has been very supportive and instrumental for us making these acquisitions that help grow the company. And to that point, we've taken away a little of that volatility and the risk of making those interest payments and certainly those principal payments. So we have about 12,700 barrels a day of hedged production. About over half of our hedge production is hedged back. So for year 2024, over half of that's hedged back to the Canadian dollar. It's been an interesting phenomenon that oil prices have been very strong. Typically, that comes with a strong Canadian dollar. So if oil prices do remain high and the Canadian dollar tends to get a bit stronger, our hedge book is protected against that because basically we sell a US dollar product. So year over year, the amount of volume that we have hedged does go down from about 59% this for 2024 to 53% next year, down to and it's down to 49%, and then 38% in 2026, and then just a small hedge remaining for 2027. So the philosophy in our hedging is we make very good money at these current oil prices, and anytime basically this year, if it falls below $70, we tend to get supported by our hedge book to make sure that we're making a strong return on our investment dollar. I do have a question about, we did recently a bought deal offering. And so what happened is we went back to some of our largest shareholders and said basically at $75 WTI, here's the amount of funds that we can repay, and here's the amount that remained for drilling. Because we have a pre-prescribed payment schedule for drilling, for debt payback, the remainder is available for drilling. So We went back to our shareholders and stakeholders and looked at that and said, if we want to have a robust drilling program of $145 million, that we need to tap up the $1 trillion bought deal. Our largest shareholders all participated in it. It was basically done by 4 institutions, and most of those U.S. based. And what allowed us to do is still make our payment schedule, and then as well to have a robust drilling program and keep production level flat. So it was done at pretty close to market. I think it's important to point out that we had basically our largest shareholders came in at $2.25. Market's not far off there. And they all took 4-month hold stock to make that injection of equity. And so that's I think that really what that also does is it puts us in the best position to pay down that debt and to be in a position to refinance that debt when that time comes. Another question here. Okay, one question. Are you targeting a specific net debt amount? And when do you think you'll be able to refinance the debt and reduce interest rates? I would say that reading into our debt agreement, we have a prepayment provision of about 5%. If we're allowed to prepay our debt at any time, and that comes with a 5% provision, that provision drops to 3% at the end of June of this year. So if we're looking to make any kind of refinancing, having that prepayment step down to 3% does make it a lot more economically feasible. So we don't have any timeline that we're given or board mandate to do the refinancing, but that's an important date, I think, to kind of to think about it as a shareholder. Good question. Why do you think you are trading at such a steep discount to your peers? What are the catalysts for valuation for Saturn? A lot of the feedback I do get is that our debt levels are above where our market cap is right now. I think most of the oil patch in Canada and right across North America has been delevering. And since we've been in growth mode, we've been going quite the opposite. Eyes wide open. Our debt holders have been paying 70 to 80% for our acquisitions, and then we're buying at very low multiples. Typically, we're acquiring at less than 2 times cash flow. So the assets themselves pay down the debt very rapidly, and you can see that quarter over quarter, we have been slashing that debt. And I think a lot of people do say that they think one of the biggest catalysts for the company is just repaying that debt. We agree. We think that once we get these debt levels down, and a lot of that free cash flow is then available for our shareholders as opposed to repaying debt, I think you'll probably see a good re-rating in the stock. I think that's the feedback most of our analysts are saying. So we look forward to that happening. And what's nice about it is we control our own destiny. So we'll look forward to that in the coming quarters. Another good question here. Considering the superior economics of the OHML wells, are they going to be a major priority for Saturn's capital program going forward? Yes, they are. And it's a new program for ourselves. Just 2 of these wells under our belt so far, but they've been great success. We've seen the industry drill about 25 of them around us last year, which really proved up to play. It was great for us. We're typically not a leader in these innovations. We've drilled a couple hundred wells here over the last 3 years. We've had a 100% success rate, and it's typically because we have we pursue lower risk opportunities to develop light oil. So, and right now, what the industry has done in the past is typically drilled 8 horizontal wells for a 1 mile length. We're seeing that now going out to about 2 miles in length underground. So that's what we're drilling now. That's a lot of well length to be drilled underground. It'll probably take about a month and a half to complete these. So they do take a while. Like I said, we're drilling one of these now. And so we're looking forward to updating our shareholders in the coming months about the success of taking this new drilling technique to the next level. I'm reading through the questions, and I think we've addressed most of these. So, and I think I'm over my time. So, I do thank you all for joining me. And again, if you have any further questions that come up down the road or want any more information, info@saturnoil.com. Please contact me. And I think there's a lot of data out there that supports the fact that there's a lot of value that's supporting Saturn shares, and I think that 2024 is going to be a fantastic year in unlocking that value that we've